Hello and welcome to everyone. Wonderful to have you here. And I am super excited. I've been investing for 28 years. I've had the privilege of investing in America, in England, in Australia, in South Africa, and even in Asia. But I have yet to invest in Germany. I've invested in Portugal and I've invested in Spain, but I'm yet to invest in Germany. And one of the things for me that is so interesting is that I've often tried to get into Europe. And I found Europe a very, very complex place. Not only do you have all the different languages, the different regulations. I know it's got a bit better with the EU, but it's been a place that I couldn't figure out how to do it. And about 3 years ago, Selwyn and myself were talking, and they were doing a deal, which we're now going to discuss with Peter, about 3 years ago. And it was, if you remember, Selwyn, it was about 700,000 euros available. And it was like, cool, let's get involved. And again, it kind of felt like the dog trying to catch the bus, because we missed that deal as well. So it's with a huge amount of excitement that I welcome both Selwyn and Peter to our webinar today to share with us what is going on in Germany, and more importantly, with regards to the Wuppertal deal exactly. So I want to basically take it. I'm going to give a proper introduction to them, but I just want to say a few things before we get started. The first is reminding you that all of us are not giving financial advice. We're sharing our experiences, our knowledge, our mistakes. Ultimately, you're accountable to make your own decisions, your own decisions for your choices. We talk a lot about diversification, diversifying across countries, currencies, assets, partners, and time. Ultimately, what are we trying to achieve? Globally diversified passive income. And when we do the either diversification challenge or the wealth going global, there's different modules. But I fundamentally believe if you want to manage risk, the number one way to manage risk is the quality of your partners. How do you find the right partners so that you can invest globally with confidence? And our mission always is to make investors and to help investors feel confident in their ability to choose the right partners. And the whole purpose of today's webinar is for you to meet the partners, to learn from them, to get the knowledge, and to understand what they're doing on the ground in terms of the execution. So I can't overemphasize the power of partners and due diligence. And I just want to share with you a couple of tips before I hand over to these gentlemen. The first is that I fundamentally believe you should be working with partners that have at least 10 years track record. Anyone can say that they've done something for 2 years. 10 years, how did they perform in the last crash? People always should be tested on how they behaved when it's not working compared to tested by how they behaved when it is working. Second, a specific market knowledge. Someone that's a jack of all trades, guaranteed it's probably going to lose your money. And the third, and probably the most important, is they put their own money into the deal. And on the same terms, it means you're aligned long term. So if your ship goes into stormy seas, you and the person that you partnered with are tied to the same mast and they don't bail overboard. If you want to go into this in a lot more detail, how to find the right partners, I literally wrote a book which was endorsed by Clem Santa, Property Going Global. And this was over 10 years ago, where I literally tried to teach people how to do this. There's an entire due diligence system, which we call our GID system. And ultimately, you can go and learn all about it in the Wealth Going Global system. GIDS 1.0, which is the global investment due diligence system, is all about residential. And number 2 is all about commercial. But today is not about me. Today is about helping you get the right information and the right partners. That is how that you diversify safely and simply around the world. So Selwyn, it's with a huge amount of gratitude that I welcome you back, and you've graced the stage many times, on our different challenges and equally on our mastermind. And you're one of the people that is the co-CEO of Callio Private Equity, and it's from my experience, the best way to invest is to work with partners that have a lot of experience already. And so Selwyn, firstly, thank you for being here. And secondly, please tell us a little bit about yourself. Who is Callio Private Equity? How do you guys find partners? What's your philosophy? Because ultimately, as a family office, you take looking after your clients' money very seriously.
Thanks, Scott. Yes, so Callio Private Equity is an unconventional private equity house. Unlike other private equity managers, we don't have a fund. We don't have a pot of money that we allocate. We have a group of investors that we work with. Recently, we started working more closely with Scott. And we find individual opportunities and we assist our network and our community of investors to allocate capital to those. And we have the benefit, because we're not bound by a fund mandate, we also have the benefit of being able to invest anywhere and in any kind of sector. We steer clear of sectors that we feel require specialist knowledge that we don't have. So, for example, basic resources we don't invest in. Or if we ever were to invest in that, we'd have to invest with somebody that we knew really well and was somehow an expert in that area. But in general, we try to stay to areas where we have a sense that we know the business reasonably well. As Scott has said, I'm one of the co-CEOs of Callio Private Equity. The other is Glenn Scorgie. Glenn and I, we've been working together since the early 2000s. We met at RMB and we ran a business inside RMB, which was a relatively interesting business. RMB itself was a very interesting institution in those days. The banking world was different from the way it is today, far less constrained and regulated. And one of the areas that we managed assets in was global real estate, actually. So we built up quite a big portfolio before the global financial crisis, and then had to manage our portfolio through that crisis. And so that was quite challenging for us. And then went into African real estate, largely on the development side. We were involved with RMB Westport, which in its day was the largest real estate private equity fund of its sort, focused on sub-Saharan African development, property development. So we've got a reasonable history in sectors such as finance and in international property, and hopefully we're quite humble. We understand our limitations. And Scott said you should invest with partners who aren't jacks of all trades. I'm not sure whether we really qualify as people who we view ourselves as generalists. We like finding people that we want to work with and finding a way to work with them. And our conventional investing is in operating businesses where we trust the management, and we tend not to take control and try to leave people to do their own thing, knowing that they understand their businesses and they know what's best. So that I think is it from Callio Private Equity. In this case, Peter will introduce himself. Our relationship is we've got investors in our network. We've worked with Peter and Encore Properties on a couple of transactions, and so we've seen how he works. But again, it's really his expertise of his team, and we focus on simply making the allocation, doing due diligence of our own, but relying quite heavily on the specialist team. Scott, any questions from you?
Before we pivot to Peter, there's two things that I wanted to point out. One is that no one likes to blow their own horn, and I think it's quite important to notice that Glenn is a CA by background, Selwyn is a CFA by background, and through Cambridge. I know he hates me saying that, but anyway, it just shows you the caliber and caliber.
Because I know my mom paid you to say that.
Yeah. No, but I just think, often people are investing and they doubt themselves and their ability to make good decisions. And it's important to know the caliber of people you're dealing with. The other thing that I think is important, Selwyn, you mentioned a few times, and I think it's a good segue to pivot to Peter, where, as you said, you've got a family office, you've got a lot of resources, you've got a decent sized team. But you said on the last time we did a presentation, there's no ways you would try to go to Germany and do it on your own. Just talk a little bit about the power of partnership, and then Peter will segue to you.
Yeah, so I think just in line with our investment philosophy, as I said before, we try to trust individual management teams. And so when we assist our investors, or we take on active roles in investments, we're relying on people who are close to the operations. And actually, in our previous history, both Glenn and I, when we were involved in RMB and in international property then, we looked at Germany and we invested in a couple of transactions in Germany. And those were actually reasonably successful. But in both cases, I'm thinking of the two particular investments, which are our largest investments. Others were tradable instruments and REIT style investments. So Germany has a slightly different regime from other places, but consider them a REIT style investments. But two of our direct investments, we relied very, very heavily on the teams that we met, and I think the lesson is always going to be that you can't run even property from a distance. It's something that requires genuine operations, understanding of tenant situations, understanding of micro markets, relationships with banks in order to get financing to work. Those are the kinds of things that need to be in place. And I would never try to run a property portfolio by remote control or by pretending that I understand the market intimately when quite clearly I can't. And it's extremely important and extremely valuable to trust the people who have experience in that market, who themselves will be trusting people like facilities managers, for example, or will have relationships with banks. And then the other thing, in our case, or in the case of what we're discussing today, in order to get properties that are in the sweet spot, I think in the sweet spot for investment, we need to work with other investors. Simply because we don't have the big pool of capital where we could take out or take on a big investable property and get it fully funded and support the debt package and the transaction work and so on. So there it's important to have the correct team and trust the correct team. But it is part of our general investment philosophy that we're trusting others and we're relying on them to be well aligned with us and to be close in terms of the knowledge and expertise required to make the asset work.
Awesome. Well, on that basis, Peter, I'd love to pivot to yourself. And Peter is coming from Israel, and I'll let Peter tell you more about himself. And, Peter, really, I'm not going to share my screen for too long here. Obviously, you've got a good relationship with Selwyn and the Calio team. As I understand it, Selwyn has done 3 separate investments with you. And Selwyn's already mentioned the sort of the track record. But this is really not about Selwyn, and it's not about Scott either. This is about Peter and what's happening on the ground in Germany. And so, Peter, I'd love you to share with us, what is going on? Who are you? What's your experience? I'm an investor. I told you already, I really want to be in Germany. I've tried to be in Germany for 20 plus years. How can you hold my hand and make that a reality?
Yeah, Scott, first of all, thank you. Thanks for arranging the webinar. I don't want to belabor the point because I think you and Selwyn already have, but I'll just say from my own experience as well, the importance of choosing the right partner, backing the right jockey. I think that almost comes before you start to analyze the actual investment and the fundamentals of the property or whichever investment you make in. And I think you've got to get that 100% correct. And if that box isn't ticked, it could be the best deal in the world. It's not something that I would want to be involved with. So, on a similar vein, Germany has got a lot of pros from a property investment point of view for reasons that we'll get into more detail with a little bit later, as has America, as has UK, as has many other Western jurisdictions. I think you correctly point out it's a lot about choosing the right jockey that has experience on the ground, as far as sourcing deals goes, as far as identifying the value adds, and then importantly, executing the value adds. Scott, a bit about my background. I'm a lawyer by profession. I was mainly involved in mergers and acquisitions. That in turn led me into tax. I pursued that. That became my predominant expertise. I left the legal world and was a senior manager in the Deloitte environment. That was all in Australia. Eventually, after about 10 to 12 odd years providing professional services, I decided I want to get involved with the coalface of deals, not just advising how deals are done or structuring from both a legal and tax perspective and from an international structuring perspective, but to do the deals themselves. And that led me to take up a position as in-house legal counsel for an international property company. In that position, I started doing some JVs with a company that was then known as Sarif. Sarif was Coronation's offshore property investment company. At that stage, they were only involved in UK under the CEO of Mike Waters. We had a tremendous relationship, and he was a big influence of my property career.
Do you mind, Peter, if I put this up? Because what you're explaining, we basically, then people can visually see. Is this correct?
Certainly, yes. Throughout the time that I was working together with Mike, I had done at that stage a number of investments both in Germany and Switzerland. Sarif was looking to expand their portfolio and diversify into mainland Europe. So we set up a separate manco, and that's how that venture started. We were a retail REIT. So what we needed to do was make sure that we could distribute dividends on an annual basis. So to that extent, we had to perform year in, year out. It was not patient capital. We didn't have the luxury of value add or doing construction without earning income at the same time. So to distribute dividends on an annual basis was a big driver. But also we weren't in passive dry income, and we had to value add as well at the same time. And that's remained an investment philosophy with me all the way until now. We're not looking for dry income. We're not looking for 10, 15-year Simon's leases. You don't need us for that. But on the other hand, we're not doing ground-up construction either. That's not where we want to be in the risk-averse basis. We want to be somewhere in the middle where we can continue to pay out dividends on an annual basis, but very importantly, identify value adds and realize those value adds. So we're very much driven by absolute returns, both income and capital growth. So throughout that period, we built up a portfolio of roughly 600 million euros. We did also have a fair amount of office buildings during that period, which we exited fairly successfully. I think our IRR was close to 20% on that investment, which the value was about 200 million odd euros. We both obviously purchased and sold a number of our properties along the way. So from an experience point of view, bought and sold roughly about 900 million euros. Fast forward in a bit, I wanted to get back into the private equity space. So 2018, I left what was then Redefine International to get back into private equity, started Encore, and we decided to remain in the German space. Similar asset class investment, while retail was threatened to a large extent by internet retail trade. Instead of discarding retail altogether, we identified those asset classes or those tenants that had a greater impact by the internet retail. So, for example, if we took electronics, certain fashion, they were probably about 20 to 30% of total trade took place over the internet. We would certainly exit and not get involved with those type of asset classes, those type of tenants. On the other hand, you've got your food, your non-discretionary spend, being food, drug stores, discount clothing, and the like, which the internet was only getting about 1 to 3%. So we started focusing on those areas. Similarly with office, we identified those areas where your work from home environment was threatening the bricks and mortar space. we would exit those and again concentrate on those type of tenants, those type of buildings which lend themselves to having to be in the office. And that's the type of stuff that we focused on. I should also mention that what's very important to us is resilience and defense of assets. You know, in the good times, we all do well. We got to make sure that in the bad times or through difficult circumstances, such as tenants leaving where we wouldn't have expected them to, there is a secondary use, there is a plan B, and they can trade through more difficult economic circumstances. And that's where we get back to your non-discretionary spend, your medical offices, your mixed-use properties. You've diversified your risk, and you're dealing with those tenants which need to be in bricks and mortar through the good and the bad, and they can perform during the more challenging economic conditions. So while that was very much the philosophy throughout our history, we've kept that in place. We found, thankfully, it's worked well for us, and we've been able to achieve both the distributions and very significantly capital growth.
Can we go to your presentation, your encore presentation? Because I think you've got some very valuable information there to share with people at a holistic level, where you kind of gone, you know, why Germany, and then within Germany, which cities and sectors, and, you know, that sort of process.
Absolutely, I can take you through that. Scott, that's just a document I'm going to have to call up if you can give me 1 second. Okay, is that coming up on my screen?
Not yet.
Not yet.
Not yet.
Should be able to. Yeah, that's coming.
How's that?
Yep, we got it now. Yep, they were perfect.
Okay. All right. So this is a document we put together showing our 4 to 5 years since Encore started. As I say, during this time, we've kept to our philosophy as to what we do and how we do. So again, we're very committed to finding the resilient property as an asset class, and making sure that we're aligning our interests. Scott, as you mentioned, we always have 10% skin in the game.
Okay, hang on, Peter. I just want to put that in English for people, just in case they don't understand. So if a building is 10 million euros, you always put 10% in. So you'd be putting in a million euros. And I just, skin in the game is kind of a colloquial term in terms of investing. But in simple terms, Peter and his team are putting their own money in the deal alongside us as the investors. And I really want to reiterate that, because it's the single most important factor I've found to success long term.
Yep. Thanks, Scott. Yeah, so I should also mention, very importantly, we are syndicating all our investments. We are not a fund, which means that, you know, when we do an investment, we do the A to Z as far as the due diligence goes, as far as getting the bank in finance, as far as identifying the upside and how to execute that upside. We will take all of that information onto our potential investors, so that all they have to do is really say yes or no. Normally, obviously, there's a number of questions which we encourage our investors to get involved with and to engage with us in that process. But typically, we are taking all the, call it, contractual risk. If the deal falls over for whatever reason, all of those costs, the due diligence costs, etc., are for the Encore account. Having said that, because we are in the syndicated space, there is obviously a lack of liquidity. And that's important, I think, for investors to acknowledge and take on board. Our holding period typically is 5 years. Recently, a lot of our deals we've exited before that time, after as early as 3 or 4 years, because what we do is, if we've maxed out the value of the property, in that we have executed the value adds that we identified, that's one piece of the puzzle. The other piece of the puzzle is where are we in the market cycle? And if the stars are aligned and we've got both pieces of that puzzle at the right stage, then we will exit. And as I say, a lot of our investments over the last 5 years, we did exit after 3 to 4 years. But during that period, there is lack of liquidity. So that is important for the investors out there. All of these buildings are generally mixed use. They've all got a lot of exposure to medical tenants, and for defensive reasons, we believe that that's worked well, again, during good times and during bad times. Our sweet spot from an investment point of view is generally around 10 to 20, sometimes 30 odd million. We get in bank finance of around 50 to 60% of that. So our equity checks are anywhere between, say, 5 to 15 odd million. We don't like to be too aggressive when it comes to banking finance. And that's mainly because we only want to knock on the investor's door once at the outset. We've never, fortunately, been in a situation where we've had to knock on our investors' doors and ask for any cash calls in order to rectify any breaches under the loan agreements if the valuation of the property has reduced beyond a certain level and the banks require you to top up. We don't want to go there, and we haven't been there. So for that reason, we are fairly, or we won't be aggressive when it comes to banking financing. We like to own the properties and serve the bank, not the other way around. We typically target deals which will give us an IRR of anywhere between, say, 13 and 16%. We have outperformed in our last 4 to 5 odd investments, and we have gotten closer to the 20 odd %. But we don't underwrite that. We would rather promise less and deliver more. We're not guaranteeing we'll achieve that, but that is more or less what we've been able to achieve until now. Scott, if you want, I can take you through the why Germany, the pros of Germany.
No, definitely, Peter. We've come here. It's critically important that we understand the macro thesis as to why Germany and the cities you're involved in and all of that. So please, fire away. I'm going to assume that people are from all over the world. Most of them are not German, and therefore they need to understand the investment thesis.
Okay. And again, let me say, I'm not comparing Germany to other jurisdictions out there. They've all got their pros and cons. I'm just going to focus in on Germany. That's the area that we know through our experience. That's what I'm going to hone in. And these are very much the reasons why we're doing that. Germany has a population of around 80 odd million, generally a strong purchasing power. One of the largest economy in Europe, and it's recently just taken over Japan as the 3rd largest economy in the world. I should update this slide accordingly. It's got political stability and economic stability to a large extent. And as I said earlier, we are looking for stability. So while there are Eastern countries which, may be more the flavor of the month, more sexier jurisdictions for a number of reasons that could give you more returns or higher returns at any one stage, we look in over the long term, and we don't want to have a curve that goes up and down. We want to be a Toyota that can solidly take us upwards. Interestingly enough, it's a very diversified country. So of a population of 80 million, the top 6 or 7 cities, if you take Frankfurt, for example, which is about your number 4th, 5th largest city, it's only got a population of around 700,000 to 800,000 people. So that shows you just how distributed the population is. Now, from a property point of view, that means that you've got very strong secondary and even tertiary locations. And those are the areas that we targeting. We're not looking to compete with the institutions who are more focused in those top 6 or 7 jurisdictions, because we can't compete with them. Their cost of capital is a lot less than ours, so they can buy at the 3-4%. But they in turn are not looking to buy in the secondary or tertiary locations, and that gives us a strong edge there. We can compete very well in those areas, because as an institution, we do have a leg up to many family offices or many other of our peers who are also investing in these areas. So a lot of these times we are investing in cities that maybe you wouldn't have heard of, but again, the metrics are going to be strong from an employment point of view, from a purchasing power point of view, and also from their proximity to your larger areas. And that would give those areas a certain strength in its own. So we're looking for areas whereby your commute to some of the A locations or some of the stronger B locations is going to be a short half an hour odd drive. The lending market is strong. Typically, we can choose between at least 100 different debt providers. That's both banks, insurance institutions, and some other insurance institutions. We have lived through, prior to obviously 2023, a low interest rate environment. But again, we want the fundamentals of the actual property to all of those boxes to be ticked. The interest rates that we get from the banks is a very important part of that. We are living now in a much higher interest rate environment. So that has to be priced in when we do our investments at the moment, and in the entry-level purchasing pricing, that obviously has to price in the much higher interest rates.
Can I just say something, Peter, quickly?
Yes, of course.
It's quite important what you just said there, that I think, you know, people sort of underestimate. From my experience, there's 3 things that are really important. One is that if you go and invest, sorry, I'm just going to get myself on my camera as well up so that people can see me. Where's it going? Shane, could you just help me quickly? So the first thing is if you invest in Australia, there's only kind of 4 or 5 or 6 major cities, people would argue between 4 and 6. So it's very hard to kind of differentiate yourself and find good deals, because it's basically an old boys club. And if you're not part of the old boys club, you just don't get access to the deals. Finished. England, not too dissimilar. You got London, and there's, you know, not a lot outside of London. What I liked about America many years ago was that it had 300 metropolitan statistical areas, which meant no one could ever dominate the entire place. And what's interesting with what Peter's saying is 3 things that are really important. One is that there's 7 major cities that all the institutions focus on, but there's about 40 other secondary cities where there's significant population, significant industry, and significant opportunity. So that's the first thing that I think is really important. It's the closest I've seen, Peter, to what I liked about America and what's worked for us very well in America. The second thing I like is that what you tend to find is that you've got 3 levels of investment. And again, I really got to get my camera up. Hang on here. Why is it not letting me share my camera? Yeah. Okay.
I wonder if I have to stop sharing mine.
No, you don't have to do anything, dude. I'll sort it out. Sorry. I'll add my spotlight. There we are. I'm being silly. I've figured it out. So there's 3 levels of investing. You've got mom and pop investing, which always is kind of below €1 million, $1 million, whatever. And that's where mom and pops run out and they try to buy residential houses overseas and they hope to make a return. It's mom and pop investing. It's very unsophisticated and it doesn't get very good returns. Then you've got institutional investing, which is right up here. And this is where they play in the €50 million plus, you know, generally hundreds of millions of euros, if not billions of euros. The challenge in this sector, as Peter's already alluded to, is that they're kind of very vanilla. Like they're kind of just looking for low risk, you know, low yield, but just stability effectively. Where the opportunity lies, and anyone that ever knows anything about property or real estate will know that you kind of want to buy a property with a twist or an angle, and you need to find the gap between the institution and the mom and pop. And what Peter's basically showing you is a strategy here, twofold. One is that there's 40 cities you can look in. Secondly, there's a whole bunch of assets that are resilient that you can look in. And thirdly, with their skill set, knowledge, and relationships on the ground, they get access to deals that none of us can get access to in that market. So sorry, Peter, I just wanted to reiterate that because I think it's really important for investors to understand the unique proposition of just putting your money into a REIT, which is the institutional, and you're going to get a very vanilla and generally quite a low return, or trying to be a mom and pop investor and run out there and buy a house, and the difference between them.
Yeah, Scott, I think that's well put, and I appreciate you articulating that maybe better than I did. That is one of the very strong drivers behind us having chosen Germany as a market. You know, from our point of view, it does make things more difficult on the ground. It means that we're having to travel Germany north to south. So we can be opportunistic in that regard. I should say that we generally stay away from Eastern Germany, not because it's Eastern Germany, but the metrics of those cities certainly are not as strong as in the Western side. Population growth is very limited. Often enough, there's a net migration out of Eastern Germany, but anywhere north to south within Germany is our playing ground, and there's a lot, Scott, as you mentioned, of cities within those areas. I think another important fact is your investment market. Again, typically we are around 80 odd billion. 2023, the numbers were a lot less. There are not as many deals as prior to that, because unless you really have to sell at the moment, you're going to hold on and ride out the high interest rate environment. But of that, approximately 60% of the deal flow is done by local German investors. And that's another important metric. In Eastern Europe, you found that it actually works the other way around. You've got a majority overseas investment and a minority local investors. And why that's important is that during difficult times, your international investors are a lot more mobile, and they will look to exit a lot more quicker than your local market does. So that's another metric that adds to the stability within the German property market. Okay, the asset base we've spoken about.
I know you've spoken about it, Peter, but I love this slide. So just give us quickly a description around this, because I'm a visual person. I know you spoke about it, I heard you, but when I saw this slide, when you first sent it to me, I really appreciated this.
Okay, again, it all gets back to looking for something that is resilient on the one hand and will ride the storms of a poor economic times, but on the other hand, not be too dry, passive income, and being able to identify the value adds and realize those value adds. So from an asset class point of view, we're looking for what is the secondary use. You know, if I buy a 15-year Simons building with only Simons as the tenant, if, you know, in a tsunami event, Simons were to be forced to leave or something, what could we do with the building? What would the expense be to slice and dice those areas to multi-tenants? Because you may not find, in fact, you are likely that you won't find such a large institution where that building fits its requirements. Secondly, do you want to be 100% in the office space? You're obviously very solely focused. You're not diversified for use or the tenant base. So that's why we like to be in the more flexible asset class. Again, typically that's mixed use, or with retail, that if a tenant had to go, it's not more than 10 to 15% of your total rent roll, and you could, without too much difficulty, without too much expense, be able to replace that tenant. The location we've spoken about, we want secondary areas, B, strong C cities areas that's still got good purchasing powers, it's got a good infrastructure and positive metrics, growing cities close to some of the larger cities. Unlocking value is a big part of what we do. Again, you don't need us for a 15-year Simon's lease, but critically, we want there to be some type of value add. You know, sometimes that might be taking a one-tenanted building, but the secondary or the upside is to get rid of that tenant, slice and dice, and where it's cost effective, because you can earn much more by rent by way of square meterage per square meter than with a single tenant. Or we can add some floors, or you know, we buy a WALT which is very low, 2 to 3 years, but we know the tenants, we know that they like that location, that they trade in well, and that comes from local knowledge. There's a number of tenants that we've got good relations with. So when we do part of the due diligence, a big part of that commercial due diligence is speaking with the tenants. How are you trading there? What is your strategy going forward? And that's the, you know, if there is such a thing as inside information on a property point of view, that is it. Off-market deals, that's critical to us. We've never, ever done a deal, you know, sourced or marketed by Jones Lang LaSalle, Savills, or one of those. We want to arbitrage. You know, as soon as you've got a structured sales process, you're probably going to get the highest price out there because it's so competitive. We prefer to do the off-market deals because we know the funds, we know the type of assets that they actually don't want on their books. It's legacy assets. It doesn't suit their strategy, but it could suit our strategy well. Those are the type, that's sort of how we look to source our deals. And then again, and that's getting back to the importance of the right partner, having an acute knowledge of the local landscape. What's happening with the city, what's happening within the area, what's happening within the tenants. So these things do move, they are moving pieces. Who would have thought that we would have such a big work from home, a change of workplace environment, largely as a result of COVID, as stuff like that we can't always think about, but we need to know that there is a secondary use out there to fall back on. And sometimes that secondary use could be the value add itself.
Awesome. Thank you for going through that, because I think when people visually see it, I'm a big believer that when you focus on fundamentals, it's fundamentals that get you results long term, because you don't chop and change, you know, when you've got fundamentals. So I love that people have the ability to understand your fundamentals of your investment decisions.
That's quite right. Yeah, so I think this slide also is very indicative of just how distributed Germany is. We've all heard of Volkswagen, Adidas, SAP, ThyssenKrupp, BASF, etc. But who's heard of their locations where their head office is based? Wolfsburg, for example, is head office of Volkswagen. Probably about 90% of any commercial activity within Wolfsburg is either Volkswagen Group itself or third-party service providers servicing the Volkswagen group of companies. Adidas, again, we all know them, but who's heard of Herzogenroth? And that's their headquarters. Often enough, the reason for that is their founders were based in these cities, and they remain very loyal to those towns, to those cities, and they stay there all the time. Ludwigshafen is another good example. BASF is very active. That's where they started off. That's their head office. So for that reason alone, that small town has got a lot of stability, a lot of commercial use there, a lot of residences who can prop up these smaller secondary type of locations. So these are the type of cities that we looking at. You wouldn't necessarily have heard about them. I never knew them before I came involved with Germany, but certainly they have got a very strong basis underpinned by your strong economy through these type of companies.
And I mean, at some level, that adds to the whole diversification theory as well, because you're now not stuck in one city. You know, I remember years ago in sort of 2011, 2012, and there were lots of South Africans buying property in Detroit. And, you know, what they didn't realize was that 25% of the city was closing down because it was a car manufacturing city. And, you know, and you're not diversified. I don't care if you own 5 houses in Detroit. It's a shambles, you know.
Absolutely, and that's important though. And in fact, I should have mentioned, if you take the example of Volkswagen, which is probably the equivalent of a Detroit there, I've never done a deal in Wolfsburg, and I wouldn't, because they are too reliant on one company, being Volkswagen. So if something had to happen to Volkswagen, and in fact, you may recall about 3-4 years ago, they got heavily penalized. I think I can't remember the reason for it. It had something to do with
they lied about the emissions,
the emissions. Exactly right. Yes, and they got into a lot of trouble over that. And you just need something like that to you know, cause a bit of a wobble within the company, and you know, your property values itself then come off. So you do want something that is more diversified. By way of an example, a case study, this is a mixed use. You've got retail on the ground floor, food anchored, which you can't see in this property. That was a supermarket, part of the Reva group. Reva is one of the largest food retailers in Europe. The offices is largely housing medical practitioners, as well as scanning, you know, your MRIs, your PET scans, etc. Those are very sticky tenants. They've got local goodwill. They need permits. We had the permits. So throughout COVID, with these type of assets, our rent collection remained almost unchanged, unaffected, but certainly was 90% plus. So again, it speaks to the story of during the good times, we'll all do well, but during the bad times, we maintained our rent collection.
That's important. You know, remember what I just said. You know, you treat people by how they behave when it's not working. So it's very important, that predictable and resilient income.
Yeah, absolutely. And this was an example of that. We had of the value add opportunities. There was a significant capex backlog, which the owner at the time was not in a position to do. Didn't have the funding. We did, so we can take advantage of the fact that the seller needed to do some capex, wasn't able to, therefore became somewhere between a very keen and a distressed seller. So our entry-level purchasing price there was certainly at a discount to market. The wealth was very low. We were able to extend that through re-gearing our leases. So that by the time we came to sell, we had a very stabilized asset. We had done the capex backlog, and we had increased the wealth. So you can see there, we bought it at 2.8%. We sold at 2.8 years. That's your weighted average unexpired length of lease. And when we sold, we had increased that to 8.65 years, so close to 9 years. And the significance of that is that brings a lot more passive investors, such as institutions, into the plain area, into your pool of potential buyers. So we could max out the value and sell to some of these institutions who would never buy buildings with such a low WALT. But now, as I say, we've stabilized and we're close on 9 years. You can see here our rent collection during COVID year was at 93%. And those are the things which really stood out, because you could imagine there was a lot of war stories over that time, with most of the retail world having to close shop for a lot of 2020. I can't say that we prepared for COVID, no one did, but that was to an extent fortunate, lucky, but again, one of those things that if you are resilient and you're dealing with the resilient industries, you will be hopefully protected during the downtime. So those are the results. A similar thing when it came to Hildesheim, it's very medical based. We had a lot of vacancy on the ground floor that we can play with, and that becomes the upside over there. And again, we took it from 2.7 years to over 9 years. And similarly,
by the way, sorry, Peter, for butting in, but what you're showing here is that, again, at an institutional level, very, very often it's just a passive investment. What Peter's showing you here is how they get their hands dirty and how they create value. And if they're creating value, that's how they're making you money. So he's told you how they're protecting your money by getting, assets that are resilient to things like COVID. But he's also telling you how they're making money by finding an angle that the other markets haven't seen and creating value.
Yeah. And one of the things we do in achieving that is we look to who's the anchor. And even if the anchor's only got 2 to 3 years, if we're confident that they can't move, or it's very unlikely that they're going to move, and that could be for a variety of reasons. In this case, we had the permits in place. There's heavy capital equipment, the MRIs and the like. There'd be a big cost for them to move. In fact, in this particular case, it was the only sole permit within the city where you could have your MRIs, etc. So those are underpinning your stability, that even though there may only be 2-3 years left on the lease, we're very confident that they'll be extending their stay. Once they extend their stay, your other medical practitioners who had maybe were aligned to the main anchor tenant are going to stay as well. And our recollection there over COVID was 95%. Another interesting example is OBI. Now, OBI is one of Europe's largest DIY stores. In fact, it's probably top 5 in the world. Typically, this is something that I wouldn't do. It's your last mile retail where your secondary use is very limited. So if OBI were to leave, either, again, a tsunami event, or at the end of their lease period, they chose not to renew, you would have a very difficult time finding a use for such a property. Today, it would be a little bit different because the logistic as an asset class is very much sought after, and these type of properties could be converted to a logistic use. But that wasn't the case 5 years ago when we bought this asset. The reason I made an exception and we bought 3 OBIs was because I knew the tenant well. I knew their trading. I had a good insight into their figures. And I also knew that OBI wanted to, as a market leader within Germany, continue expanding. Now, your ability to expand by new stores was very prohibited. One, by this stage, your cost of labor was prohibitive. Your timing that you would need to get the permits was very difficult, remains very difficult. 3, your floor print for a store like OBI, you need around 15,000 square meters to build a 10 to 12,000 square meter floor space. That's very difficult to find. So you put all of those together, their ability to grow by way of new stores is very limited, very unlikely, therefore, to leave the existing stores. And certainly, if they're performing well, they're not going to. I had that information. We bought it. It's probably in the next slide. We bought it
March 2020.
with about 3-4 years to get. It had about just short of 5 years. By the time we sold, it would have been about 2 years, but we got the tenant to increase the lease. They went to a 10-year lease. We continued to hold for 1.5 years. Our rent collection over this time was 100% over COVID, and we had a very successful exit. I think it was close on a 20% IRR.
Peter, that's the one that makes me super sad, because that's the one that I was referring to with Selwyn that we tried to participate in, and we just couldn't execute fast enough. So it's one of those things where I'm really grateful you made money for investors, and I'm really pissed off I missed out.
Okay, fair enough. We'll just blame Selwyn and not me.
Yeah, that's fine.
So that's it as far as what we're doing and how we're doing and what the investment strategy is, and what we've done over the last 5 odd years.
So tell me, so Peter, firstly, thank you for that. That's brilliant. I'm going to steal the screen back off you if you don't mind. And what I wanted to do for everyone was what Peter's basically taken you through is this kind of philosophy here, as you can see on my screen. So any sort of investor should be thinking, right, firstly, why Germany? Okay, and he's been through that. Secondly, where in Germany? Which cities do you invest in? Thirdly, what do you invest in Germany? And finally, how do you actually do it? So let's get to the how. And I always like to use a real deal to talk about the how. Talk to us about Wuppertal. I'm an investor in this deal, and what I mean, I know it hasn't closed, but I've put my money in to potentially invest. And I'd love to kind of know, Peter, in terms of the how, where are we at? What is happening on the market, on the ground? What do you suggest I do in terms of my investment there? The fact I want to get into Germany, I want to earn an income producing asset. Where are we going over the next 3 months, and what do I do?
So again, I can't speak for all investors. Any investor has got their own investment philosophy and requirements, etc. I think the important thing is to understand what we're doing, how we're doing, and our investment philosophy, and see whether that is in line with what any one particular investor is looking for. This current investment in Wuppertal, we are doing look to do as part of a bigger portfolio, together with 2 assets in Dortmund and 1 in Duisburg. They're all within about an hour's drive of each other, so it's manageable from a property management point of view, and there's a lot of synergies between those properties. And why I say that is Wuppertal is probably a little bit different to what we would usually do, in that it's already got quite a long WALT. The seller is a property developer that's done very well in putting up this development. It used to be a single Simons office building. Simons did downsize, so they didn't need all the space, and the developer was able to convert a lot of that space into hotel, office, gym, and retail. So he did a good job there. The WALT was fairly high, so you're buying already a stabilized asset. Not typically what we would do. We like to stabilize the asset, but the big plus here was you're purchasing the entry price. We believe we got a very good deal here. Again, in 2023, we're looking for the opportunities. The market is sufficiently, call it distressed, to be looking for those opportunities. And it was really the purchasing price rather, I should say, at multiples of around 12, 13-fold, where previously they would have been closer to 18, 19-fold. It's important to see the portfolio. Scott, if maybe you go back to the previous slide, or what you had on the screen, because you'll then understand the synergies. The properties in Dortmund and Duisburg go well with Wuppertal, in that there is more opportunities there to value add. They're also fairly stabilized. They've got, it's about 85% occupied, to very defensive, stabilized tenants in the largely medical sphere again, and education. And there we've been able to buy this from a fund that we've done deals with in the past, and we've been able to secure excellent purchase price. So we remain excited about this deal and the upside that we can hopefully achieve. And we buy in, we believe, at the right time of the market cycle. When we started in 2018, a lot of our investors said to us, you're actually starting very late in the piece. The market had run its course, and it was quite a buoyant property market worldwide, Germany as well. And our view at the time was acknowledging that we don't just ride the cycles. We are going to value add, we're going to sweat the asset, and we'll create our own value. And fortunately, that's what we were able to do. Having said that, this is now a buyer's market. So we would look only for the opportunities where we're going to get very favorable purchasing price, plus the value add opportunities that we do. Hopefully, that's going to create for good exits once the markets stabilize, whatever that period is.
So Peter, where to from here in terms of, you know, this, you've got the 3 different buildings, you're putting them together in a portfolio. My understanding from when we met face to face was you were thinking about possibly segmenting them into separate investment opportunities. What does the timing look like over the next couple of months? And yeah, how do I start earning a return?
Yeah, so you're quite right. These are actually 2 separate sellers. The Wuppertal is one seller. The other 3 properties, 2 in Dortmund and Duisburg, is a second seller. We do need a lot of capital to buy the entire portfolio. It would be roughly 15 odd million. What we're doing is we're saying, let's start off and concentrate of the one that we prefer, that if we only did one, it would be the Dortmund and the Duisburg portfolio. And that is because, as I say, there are more value add opportunities. We are almost finished our due diligence on those properties. That's the legal due diligence, the technical due diligence, as well as the ESG due diligence. ESG being a very important part of the property world at the moment, particularly when it comes to offices. We are already in the first few rounds of the SPA, being the sell and purchase agreement. So we'll probably look to finalize that agreement by the end of April. There is then a period of around 2 to 3 months where from a legal point of view, the property has to be transferred in the what they call the Grundbuch, which is the state's legal offices, the land register, as it were, where that has to change, and that's a process which takes 2 to 3 months. So we would look to complete that acquisition sometime, probably end of June. By the end of June, we complete the sale. We become the owners. We obviously then manage the property. We're responsible for everything about the property. We do our distributions on a biannual basis, generally August and February of each year. And again, the holding period, we would look to say as a guidance around 5 years.
Okay, so let me just get clear in my own head. So I've already participated on the Wealth Migrate platform. I've said I want to go into the deal. The deal dynamics will be changing slightly. And so what my proposal is, we will be updating the deal dynamics specifically once the due diligence is complete from Peter and the team. What an individual has, because it's on a platform, it's called a book build. So if I just share very quickly, and if you don't mind, Peter, I'm just going to jump because I want to kind of show people what their options are here. But if I go into Wealth Migrate now, and I'm an investor in the Wuppertal deal. So if I log in, I'm not giving a platform presentation here, I'm just showing you very quickly how it would work. Is I go to my portfolio, and you can basically see that I've got, so in terms of, so I actually don't. So let me just go and I just want to go and I want to basically invest in Wuppertal. Let me invest in this deal quickly so you can see what I'm talking about. So this is a live deal on the platform right now. And what we would need to do for investors is we will obviously let everyone know that the deal metrics would be updated. And you would have Project Wuppertal here. The name might change slightly based on what Peter's just said. If I don't like the new deal, I can literally go cancel investment. If I do like the new deal, I just stay in the deal and it will close as per the timings that Peter said. So, and literally cancel investment is as simple as remove my investment. So just to let everyone know, based on what Peter said and what he guided, you know, our Chief Investment Officer, Paulo, met with Selwyn and Peter and myself and Alex on Monday. We said, look, let's chat about this. We want to basically start investing. We want to start getting a return. How do we do this as quickly and simply and safely as possible? And that was my understanding. Peter, tell me if I'm getting it wrong, but that was my understanding. We've got the timing. You know, I've committed, as an example, to the deal. It allows us to just update those deal dynamics based on the due diligence you've just mentioned, and then we can execute based on the timing of what you discussed. So I think it's a fairly easy, transparent, and very, very workable solution. It's very low hassle for anybody, unless someone decides that they really liked the one particular building and you know they want to exit the deal. Well, they've got that full choice before the deal closes.
I think that's absolutely right. And that is, again, one of the maybe advantages of doing syndicated deals. You know the bricks and mortar that you're going to get involved with. If I was a fund, I'd probably put them all into the fund, but that's not the case. So we'll do the Dortmund and Duisburg deal as a standalone. An investor would want to make sure that those assets are the type of investments that he or she is comfortable doing. Wuppertal will be hopefully an entire separate transaction. And again, one could look at that on its own merits.
Perfect. Someone just quickly, and I'll get you up on screen as well. Any comments or any thoughts from your side? Because obviously you and me, Selwyn, are in the same boat here. Both of us have a number of investors that want to participate. And I think one thing that I would say, and then I want to pivot to Selwyn, is that I've always invested in deals for the partner, not for the deal. And the reason being is that the partner is the expert on the ground. I'm not going to sit here and try to sound like I'm an expert in which city to invest in and which building to invest in. So I take a lot of guidance from my partner on the ground who has the experience. But from your perspective, Selwyn, what's your thoughts in terms of, you know, it's building A versus building B? Does it matter in any way?
No, look, I've looked at both Wuppertal by itself and then the combined portfolio, and yes, I think that the correct thing is for your investors to want to invest in all of them and make allocations to all of them. But yes, your point is absolutely correct, Scott. The thing is, who's going to manage them? Do they have the right kind of investment thesis behind them? Are they good investable assets? And I don't think there's any question about any of the assets that Peter has sourced. But these are going to be good assets. There's the possibility of value add and so on. So I'm very comfortable in talking to my investors and saying to them, this is what's happened. But you know, I think the correct thing is to shift the allocation to the portfolio that's available now. Yeah, and Wuppertal, hopefully we will get to see it again. But if not, I trust Peter to find equivalent opportunities for us in the next while. I don't know, Scott, you're always looking for opportunities. So yes, I feel very comfortable with that, and I think your statement is correct. It's more to do with the people who are going to be running it than it is being attached to a specific asset.
Yeah, look, there's two ways of looking at it as well. There's, you know, again, it's always how someone's brain works. You could look at it and go, oh, well, it's a negative. I actually don't look at it as a negative, because if I had $100,000 and I now invest $100,000 into the first deal and I invest $100,000 into the second deal, well, I've now diversified across two separate deals, whereas, you know, I would have had $200,000 all ring fenced in one deal. So I actually see that back to diversification as a huge plus. The second part to that, as Peter said, is that the Wuppertal deal will take longer, and the feedback from him and even from our own investors is, let's get the capital working. So let's do it in a two-stage process. And, you know, for me, it's a kind of a no-brainer based on both of those, both of those elements. I can't think of the word, facts or whatever you want to call it, basically, principles.
Yeah, The one benefit that, from a diversification point of view, that is immediately present is that the first portfolio is a portfolio already. It's got 3 properties in it, whereas Wuppertal, although it was a very diverse property with multiple uses, and it was very well strategically located, in this case, you're actually getting two different towns and 3 different properties. So you're getting diversification. In some ways, this is the better way to do diversification.
Yeah.
Is to do the small portfolio first, and then maybe the individual property later.
Yeah. Peter, the last question I have for you, and someone's already alluded to it. Every investor that we ever talk to comes to us and says, okay, but this is a wonderful building. What else is coming down the pipeline? You know, should I sit and wait? And, you know, the kind of the usual investor mentality. I suppose it's a twofold question. One is, you know, obviously there's a deal on the table now in the next 3 months, which you've already explained. So I don't think we need to go into that in any more detail. So the second part of the question is, what do you see coming down the pipeline? And I do want to add one caveat before you say anything. I know from Selwyn's perspective that you didn't do a deal at all in 2023. So you don't bring deals for the sake of doing deals. You do deals when firstly, your capital is being looked after because you're putting your own money into the deal. But secondly, when a deal makes sense. So I just want to give a caveat before Peter even talks that you'll only be bringing deals if they're good deals. But with that context in mind, what's coming down the pipeline for us?
Scott, I think that's an important point that you raise. Not being a fund, we are not forced to deploy any capital. We are not forced buyers. So as you say, in 2023, we didn't do a single investment. So, you know, that's where our company Encore takes the hit. But I'm absolutely comfortable there, because the only thing worse than not doing a deal is to do the wrong deal. So we're not forced buyers. What we were waiting for was the more distressed, opportunistic buyers as a result of a lot of sellers being in distress. Now, we are seeing those opportunities come as far as developers falling over, and we almost see that literally almost on a daily basis. But we're not developers. We're not in a position to stand in their shoes and take over that type of development projects. What we are expecting during this year and next year is more distressed sellers to come to the market as their debt facilities start to expire and the values have gone down and they're not in a position to put more equity into the deal. We saw a lot of that happening in the GFC period, 2007, 2008, even into 2009. And that's what we're expecting now. So, you know, hopefully we're one of a few vultures out there looking to take advantage of the distressed sellers. But again, we're not in a forced position to buy. We'll only do it if everything stacks up.
Perfect. I'm conscious of time, and I only asked for an hour of your time, and you've very generously shared a lot of knowledge. I always joke with people, when you're sharing decades worth of knowledge into an hour, it's a lot trickier than people think. But I just wanted to put it out there. If anyone has any questions, just literally type it in the chat box. While I mean, I've asked all the questions I wanted to know, so I really want to appreciate. But if anyone has any questions, chuck them in. There were a couple of slides I just wanted to share, and if the questions come up, I'll ask them in the meantime. We've alluded quite a lot to the diversification challenge. You know, this is where ultimately in day one, we talk about understanding diversification. In day two, it's types of investments. In day three, it's building a diversified portfolio. In day four, it's all about risk, which is exactly what we're talking today. It's the partners. And finally, in day five, it's about putting it all in practice. So if you're keen to join, that's the link for our next challenge. And in conclusion, you know, a bird flying on a flock can fly 70% further than a bird flying on its own. If you still have the mentality of, I'll go to Germany, I'll do it all myself. I'll go to London, I'll do it all myself. I'll go to New York, I'll do it all myself. Really consider the laws of nature prove that by working together, we can go a hell of a lot further. And as Nelson Mandela said, money won't create success, the freedom to make it will. And I finished with a little video for you.
I have walked a long walk to freedom. It has been a lonely road, and it is not over yet.
Ladies and gentlemen, I want to thank you for your time. Peter and Selwyn, I really want to thank you for your time. And I think what's important, I can see a couple of questions, but let me just conclude and then I'll do the questions. What's really important in why I finished with the Nelson Mandela story there is it is a lonely road on your own. To try and invest internationally, to go to any one country, let alone any city, is very, very lonely. To do it together with quality partners, as Selwyn has alluded, as Peter's alluded, hopefully gives people peace of mind in terms of what's happening. I deeply appreciate you sharing with me and everyone else the investment thesis around why Germany, why the cities, why the asset classes. And this is not only important for today and this particular deal, but it's important for the future, you know, in terms of being able to invest within the euro. And, you know, I won't get into the whole specifics around the euro to the dollar, but there's quite a lot of research out there that says the euro will be increasing in value against the dollar. And so again, as any sort of global citizen, one should be looking at these market dynamics to choose where to invest. So final words and conclusion from your side. Let's start with you, Selwyn, first, and then we'll go to Peter.
Yeah, thanks, Scott. I think, you know, you and I have discussed many times the value of diversification. It's built into our investment thesis. And you've also always emphasized the idea of partnership. As you've said, we would never be able to do a deal in Germany, no matter, even given the fact that I personally have been involved in deals in Germany before, without having the right partners. So that I think is extremely important. I think in this case, we've gone through a process with a particular deal with changing direction. I think people need to just accept that and see that is probably the most rational decision, that you're very well aligned with the people who are managing the deal. And so they're presenting you with what they see as in their interests, which will be in the interests of our investors, the Calio investors, and I think your investors, Scott, as well.
Awesome. No, thanks very much, Selwyn. Deeply appreciate that. Peter, final thoughts?
Yeah, again, on that, for example, on the Wuppertal deal, if, and hopefully it won't get to this, but it might, if we're not able to close all the deals and we're only able to close the Dortmund and Duisburg deal, all the cost is with Encore. So we take the hit. That is a benefit of doing this model rather than the fund where that would be sunken costs to the fund itself. Two things I'll just add only because I never alluded them earlier and I'm reminded now. We're very well structured from a tax point of view. Everything we do is on the advice of EY's, their Berlin office. But given my background, I'm very involved with our tax structuring. And I always make the joke, the only person paying tax within our group is myself. We're able to get our profits out of Germany into our holding company jurisdictions, which is typically Luxembourg, on a tax-free basis through various tools, both funding and legal tools that we're able to use. We are not able to avoid a capital gain on the growth of the property, but you know, sometimes that's a good thing. It means that you are making those capital gains, and they are all funded, of course, by your proceeds at the end of the holding period.
Awesome. No, well, thank you very much, Peter. That's a wonderful little bit of insight that you brought up right at the end there. So that's very, very valuable. I want to thank you for your time. Thank you for sharing, and thank you for, you know, ultimately helping and guiding people. Obviously, it's still their own decision. And as Craig said here, so with Wuppertal deferred and another 2 months to close in the next 3 months, should we cancel investment in Wuppertal and reinvest in a replacement investment? Possibly. Craig, it comes down to each individual. You know, if you invest in another investment and earn a return for the next 3 months, and when this is ready to go in the next 2 months or so, you reinvest in that, you know, but that's a personal choice. What we believe in, and our 3 core values are trust, transparency, and alignment. What we're providing you today is the transparency so that you can make the right decisions. But I have no doubt that people have walked away here trusting what they've learned from Selwyn and from Peter, and hopefully understanding the alignment. What Peter just said there, not only does he put his own 10% into every deal, but any due diligence they do, they take the costs. And if they don't do the deal, they wear that, which is even more incentive for them to make sure that it's good quality deals. But they'll walk away from a deal to protect their capital and their investors, and they wear that cost. So that, you know, when someone's telling you not to do a deal and they've got that sort of impetus behind them, trust me, you should be listening to them. Thank you, everyone. Have a wonderful day. Cheers.
Scott, thank you.
Thanks, Scott.